about budget preparation. Budgets are an important part of companies. This is pretty much how you take the plans of the company or the planning component and put it down in financial data on paper. So it's really your company's plans in financial terms. So I want to walk you through the illustrations that we have in Chapter 20 for the different types of budgets. So these are all going to be illustrations that you can see on the presentation here, or you can follow along in your textbook. I'm going to do the same ones that are given in your text and talk you through what these are and what the information means. First, let's just look at the different types of budgets we have. Okay, all of these are part of the master budget, but we can divide them into operating budgets and financial budgets. Operating budgets, you start off with your sales budget. This one always comes first. From there, you can do the production budget. Off of that, then you can do the direct materials budget, the direct labor budget, and the manufacturing overhead budget. Then you can get to the selling and administrative expense budget, and then finally that culmination, all of those budgets together, we can then do a budgeted income statement. The financial budgets, we have capital expenditure budget and a cash budget, and then based on that and the previous information from your operating budgets, you can prepare a budgeted a budgeted balance sheet. So let's look through those illustrations you've been given and get a little more explanation on what these are and how we would determine these amounts. This is the first budget. It's part of the operating budget. It's the sales budget. This is where you're going to start all of your budgets off. First thing we have to do is figure out how much you are going to have in expected or budgeted sales figures. So for our company here in this illustration, we're looking at each quarter of the year. So we have a column for each of the quarters, first quarter, second quarter, third quarter, fourth quarter. And then we also have the total for the whole year. So we're expecting, and again, these would be numbers that your management team would come up with. We expect 3,000 units in sales for the first quarter, 3,500 in the second, 4,000 in the third, and 4,500 in the fourth. So for the year total, we expect $15,000 of annual sales in units. But again, these vary quarter by quarter. And then we just put in how much we expect to sell them for in each quarter. We multiply that out, and that gives me my total sales figure as a dollar amount for each quarter and for the year. Not too hard. And so literally all you're doing is how much do you think you're going to sell, how much you're going to charge for it. There's your expected sales figure. Okay, we have to do this first because the other amounts we're going to base off of this. First I have to know what I think I'm going to sell, then I can estimate some other figures. So the next thing we come to is the production budget. Right? Production depends on sales. So first I have to figure out how much I think I'm going to sell. So we did that first, and that's what we're referring to, that illustration 20-3. So there's those same numbers that we had in each quarter. The 3,000, excuse me, got the yawns today, sorry. The 3,500, the 4,000, and the 4,500. Okay, so we got those from that sales budget. Now, I also need to consider something else. All right, if I'm expecting to sell 3,000, do I need to produce 3,000? Maybe. Two things I need to consider: ending inventory and beginning inventory. So, do I want to just make and exactly sell 3,000 units? If so, that would also be my production budget. But if I want to sell 3,000 units, but I want to have some left over at the end of the period, just in case I have, I sold more than I expected, or I have some waiting so that I don't have to have immediate production, the next day of the next year, and I have some sales. So I like to have a little cushion there. So maybe I want some finished goods in ending inventory. I don't want to sell them, but I do need to make them, and this is the production budget we're looking at. So for first quarter, for instance, I expect to sell 3,000 units, but I want 700 left over. So I'm going to actually have to make 3,700 units if I want to keep 700 left over, and if I'm going to sell 3,000. But the other thing to consider is, what about beginning inventories? Did I start the year or the quarter off with some inventory already? Okay, if so, do I need to make 3,700 units? No, because I had some left over, so I can sell those before I have to make any more. So we need to subtract out any beginning inventory. For us in this quarter, up to this point, we have to make 3,700. But we have beginning inventory of 600 units, so I don't have to make those. So I only need to make 3,100 for the first quarter. We're going to go through that same process for the second, the third, and the fourth quarter, and that will give me my annual total of production in units. $15,400. Okay. Now, there's a way that you can figure out why you would want finished or how you would want. For instance, I've got a little key here. We estimate 20% of next quarter sales, and that's what we want to keep in ending inventory, for instance. So I'm expecting, $3,500 in sales in the second quarter, so I want to keep 20% of that as ending inventory in the first quarter. So there's ways companies have to figure that out. They're not just arbitrary figures. After the production budget, then we get to direct materials, direct labor, and factory overhead. So the first one is direct materials. Well, if we look at our production numbers, we estimated we were going to have 3,100 units in production for first quarter. Okay, well, whatever it is we're making, we need to look at the direct materials for that. Well, how many pounds or tons or gallons or yards or square feet, whatever our material is that makes that, how many of those do we need to make that production level? We know we want to make 3,100 units. Well, it obviously takes me 2 pounds of that material per unit. So I'm going to multiply that by 2. That tells me the total number of pounds that I need for production. So I need 6,200 pounds. But again, what if I have some that I want to keep so that I have materials left over in ending inventory? Well, if that's the case, then I need to order more than 6,200. So if I want 720 left over in the warehouse there, after I'm already finished with those, then I need to add that in. So now I'm up to buying 6,920 tons. Sorry, not tons, pounds. But also, just like we did with the production budget, what if I had some to start with? What if I had beginning inventory? Well, I don't need to buy those. I already have them in. So we want to subtract that out. So instead of ordering 6,920 pounds, I can subtract that 620 we started with in the first quarter. Now I only need to order 6,300 pounds for our direct materials. Okay, that's in pounds. I need it in dollars. So how much is it going to cost me? Well, it cost me $4 a pound. So in total for the first quarter, I need to order $25,200. And again, I'm going to do the same thing for each quarter. And then I can get an annual total, $124,800. Now, this may sound complicated, but think about it this way. Trying to give you a more simplistic, because you could have one product that has 5 different types of direct materials. What if you were making paper airplanes? All right, you're going to make 5 paper airplanes, and you need 1 sheet of paper to make each of those. And how many sheets of paper are you going to need? 5. Okay, going with the simple math here. But what if you already had 2 sheets of paper to begin with? Well, you don't need 5 sheets. You just need 3 sheets. But what if you'd like to have 1 sheet of paper left over? Well, now you need to add that one in. Now I need to get 4 sheets of paper to make what I want. Okay, so don't let all of the numbers confuse you too much. That's really all we're doing. If you just think it through, hopefully it makes sense. All right, good. We got materials. That's one part of production costs. Second one is direct labor. So again, based on the production budget, which we looked at 2 screens ago, those are our units that we're estimating to produce in each quarter. Based on that, I have to figure out how long it takes me to make each unit. Well, for us, it takes 2 hours of direct labor per unit. So for first quarter, for instance, that means I'm going to have 6,200 hours to make those 3,100 units. Again, I need this in dollars, so I need to look at how much I'm paying my labor. We have a labor cost of $10 per hour. So I'm going to have $62,000 in direct labor charges for the first quarter. Again, we're going to do the same thing for each of the remaining quarters, add them together. So for the year, I have $308,000 in total direct labor costs for all year. Last production cost is our manufacturing overhead budget. So we've divided this into variable costs and then fixed costs. Top part is all our variables, so we've listed those out, and they vary with something to do with production. For us, this varies per direct labor hour. So, for instance, indirect materials, they told us that it's $1 per hour. So all we need to do is go back and see our direct labor hours. Okay, let's again just look at first quarter. And we see that our total direct labor hours for first quarter were 6,200 hours. So if we have $1 of indirect materials for each hour. That's $6,200 for indirect materials. For indirect labor, it's $1.40 per hour. When we know we have 6,200 hours, we multiply that by $1.40, that gives me $8,680. We do the same thing for each of these other indirect charges and get a total. The fixed costs are fixed. They don't vary with production, so I don't really need to look at production levels for this. They're going to be the same thing each quarter. So we're just going to put those in, add them up. So for first quarter, my total is $57,100 for direct materials. For manufacturing overhead. We do the same thing for each quarter, add those up. So for the year, I'm expecting to have $246,400 in direct materials. Now I can also, since direct labor is the cost driver here for overhead, we can put our direct labor hours in at the bottom and get a total overhead rate per direct labor hour, if that's the way we allocate out our overhead. So for us, we had $246,400 in total manufacturing overhead for the year, and we had 30,800 hours in total direct labor hours. So that gives me an $8 per hour overhead rate. Now, after all of our production costs, we move into our period costs, our selling and administrative expenses. So we would put these down again. I've separated them into variable and fixed charges. And we've got our budgeted sales up there because our variable expenses are based on sales units. So for instance, sales commissions is $3 a unit. Well, in quarter one, we've got 3,000 units at $3 a piece. That'd be $9,000 in sales commissions. Okay, freight's $1 per unit. So we look at our units and sales, and these are sales figures, not production figures. And that'd be $3,000. Okay, the fixed don't vary. They are fixed, so they're going to be the same each quarter. So we're going to put those down, add everything up, and get our total selling and administrative expenses for each quarter, and then again for the year. After we've done all those individual budgets, now we're ready to make up a budgeted income statement. Okay, sales we get from the sales budget directly. Cost of goods sold. Well, again, I know how much I'm expecting to sell from the sales budget in terms of units. But the cost side we get from direct materials, direct labor, and manufacturing overhead. So you could actually go and add up those totals. Let's see. Direct materials, we had $124,800. Direct labor, we had $308,000. These are annual totals I'm looking at. And manufacturing overhead, we had $246,400. You could add all those together and divide by our total production level, which was, I believe, 15,400 units. And that would give you a per unit charge. Or you could actually get the per unit amounts. For instance, direct materials per unit. Well, I know it takes 2 pounds per unit, and that costs me $4 a piece. So that's $8 a unit. For direct labor, I know it takes me 2 hours per unit, and it's $10 an hour. So that would be $20 a unit. And then overhead, we've actually already calculated the per unit charge. It would be $8 per unit. So either way, you're going to be able to figure out this is going to be $44. If you do it in totals, though, it's actually going to give you a couple of cents. But if you round, it's still going to be $44. So we multiply that by our total annual sales, which is $15,000, to get me cost of goods sold. The difference there is gross profit. Our selling and administrative expenses come from that budget that we previously did. That we subtract that out from gross profit, and that gives me income from operations. Interest expense would be something we would need to get. We haven't done a budget for that. And that gives me EBIT, earnings before income and taxes. That's just EBT, earnings before taxes. Then we'd have to calculate our income tax expense based on what percentage we're expecting in taxes. And then that's going to give me net income. But these are, again, estimated figures based on those previous budgets that we've already compiled and calculated.